Um, Hi, everyone. My name is Gideon. I grew up in South Africa, and I went to college in the US. And then in 2008, I moved to London. I had a degree from one of the top global universities, a job at an investment bank, which was then actually the largest company by market cap on the planet. And I walked downstairs on my second day of work to speak to the same bank about getting a bank account and a credit card. And needless to say, I wasn't able to get one. A few days later, I went to go try rent an apartment, and I wasn't able to rent an apartment unless I got vouched for by my aunt and uncle living in North Finchley. Okay, so that's my story. Coming to the UK, feeling like large organizations that clearly had a job to do providing me a service were just not able to do it. Meanwhile, I'm in the world of underserved financial customers. I was one of the lucky ones. For me, it was just a matter of time before I had enough history, employment history, bank account history, to be able to get access to loans, to be able to have a good credit score with apartment rentals. Down in Nigeria, we have a lending business called One Credit that lends to rural Nigerians who, in 4 lifetimes, would never have a credit score. Ukena runs a kitchen in a village in Nigeria, and she got a loan from our customer to scale up in terms of pots and pans and hiring young people to build a food business. Around a similar time in 2008, my co-founder, Masha Dolinsky, had started an online lending business in Poland. He was only able to approve about 12% of people under the age of 35 that applied for him on a loan. Only 20% of those applicants had bad credit history, so most of them had nothing. How big is this information crisis? In Europe, we estimate about 25 million young people who get rejected a year because of a thin file. In emerging markets, the problem's much bigger. We estimate at least 1.3 billion people who do not have public credit profiles but are very active internet and mobile users. So what is it? What's the change that's happening? Remember, we're not challenging the banks here. We're really challenging the credit bureaus. We're challenging the businesses that even the banks complain about. So what is the difference? International relevance, right? That's a picture of the Berlin Wall, which was kind of the first thing that came to mind when I thought about my inability to access finance when I moved to the UK. At FriendlyScore, we are using social media and online data to improve people's credit profiles. This means that anyone that uses the internet a lot, we can understand and build a credit profile for. This means that when I moved to the UK, I could have used my LinkedIn profile, my Facebook profile, my 10 years of internet history to show a bank that I would actually be a good borrower. Inclusion, there are 4 billion people in the world that are underserved. Soon, 2 billion of them will be active internet users. Data robustness, credit bureaus use credit history and some difficult to verify personal data. We crunching thousands of data points per person, machine learning algorithms that are getting smarter and smarter all the time. Modernity, the old metrics are how long you've lived in a country, had a job. This reminds me of the old landed aristocracy, as I've found a picture of there. The modern customer of an online lending business is a young millennial, internationally mobile, often a freelancer or self-employed. So what does the product look like? We ask the borrower to log into some of their profiles and consent to scraping lots of data about them. And the lender can either download any of this data through an API or monitor the score, the analytics, and the data through a dashboard. What data do we actually look at? We've painted a picture there for you of what our current scorecard looks like. I'm going to simplify it one step further. We look at a lot of the data that banks and credit bureaus already look at. We look at where you live, where you work, where you've studied. We just now have it from a completely new source on many, many more people. Then we look at a lot of new data we're discovering as predictive to creditworthiness. We're looking at your social network, who you communicate with, who you interact with, how often, how long you've known them. We look at behavioral and communication patterns. how do you speak, how do you engage socially, what hours are you active, what are your interests, what are you following. Talking of buzzwords, machine learning does get thrown around for the data geeks out there. I'm going to go into it just one step further. So the task we're assessing is creditworthiness, so whether someone pays back a loan or not, using all this alternative data. The input variables from the slide before, lots and lots of data. We're testing it against the performances of the loan. So we work very closely with our lending partners to get some feedback on how their customers are performing. The type of task, we perform two distinct type of data analytics tasks. The first is classification, whether someone defaults or doesn't default. And the second is ranking, so that's order of riskiness of the customer. The evaluation metrics on the business of our customers are about reducing false negatives, so that's increasing approval rates, reducing false positives, which is decreasing fraud, and rank order positives, specifically with the no defaults. This is about pricing risk more accurately amongst the approved borrowers. We've performed all three use cases in the real world. I'm not going to go into too much detail here, but in Poland, we've picked up over 100 frauds. These numbers are small, but bear in mind we're a very young company. We're only a year old. In Poland, we picked up over 100 frauds using our geolocation data and our ability to validate against the data given from the customer against all their online extracted data. In Holland, we were able, for a particular lender, to increase approvals by 60 people per month without any increase in underwriting risk. Here, declined borrowers were given the opportunity to use FriendlyScore as a way of then becoming accepted. And in Germany, we were offered to the approved customers as a way to improve their internal credit rating, and we saw that our A and B classifieds defaulted much less than the average, and our C and D defaulted much more than the average. That customer is now using us to price risk on many more of their customers. In terms of how the business has done, again, not a lot of history here, but I'll just finish and say we've got over 20 businesses using the product. We've got over 10 businesses paying us. Revenues are increasing even faster because of the increase in price that the constant increases in pricing.
Thank you, Gideon.
That's it.
Thank you. Thank you very much for the presentation. Before we conclude, a round of applause, please. Yes. Questions from the... yes, please.
Among the different criteria or factors that you use to get to a ranking, what are the top 3 criteria that has the most weight in your whole average?
You want specific factors in the scorecard.
Yes.
So it does depend where in the world, but let's talk about people like us in Western Europe. LinkedIn data has been the most predictive, and it's actually the same stuff that the highest correlations have actually been seen in the same personal data that is being used by banks, and that's around your employment status and history, your education status and history, including number of degrees, quality of school, that type of stuff. And for a third one, there's a few. I mean, I could give you a more interesting one is number of family members connected to and communicate with, and very old friends connected to and communicate with.
Yeah. I've got a question. You said we get some feedback of lenders. Mm-hmm. I believe in the mixture, if you rate the risk as a lender in your traditional way and add on social media, then it's extra powerful. How do you get that total information?
How do we get? So all we ask the lender is to tell us who defaulted and who didn't default. We don't ask for the. So we're scoring all these customers, and then we just want to know how they perform. Right, that's all we need to train the algorithms to improve. The lender's using our output and the traditional credit bureau data to make a better decision. Does that answer your question?
So you don't get the data analytics on the total client.
So we don't need that. All we need is to know if the guy defaulted or not. We are doing some tests with some of our customers where they've agreed to share what their traditional, what the bureau would say about them. That's just a way for us to test the algorithms a little bit further, but that's not necessary. So we don't need that at all.
Excellent. I think we can just take one more question.
So I know a peer-to-peer lending site, and a week ago they complained to me that only 3% of their customers are willing to take the social media credit scoring. They are working with one of your competitors. And what would be your argument to this peer-to-peer lending site? How would you motivate their clients to get their social media credit score?
Yeah, that's a very good question. We spend a lot of time thinking about this. We call it user conversion, and there's three key drivers of of solving this problem. The first is how you communicate what you're doing and what you're not doing. It's very important that people understand why you're asking for it and what you're going to do with their data, that you're not going to sell it and you're not going to read their emails, but you're just producing an analytical output. The second is where in the process you're asking for it, right? So if you just like someone's applying and then they get approved and then they have an option of adding Facebook, no one's going to do it, right? You need to ask for it either in the application process compulsory, after being approved as a clear way to get a better cost of capital, or after being declined as your only way of potentially having the decision overturned. In scenarios like that, conversion will be much, much higher. The third, related, is the financial incentives, right? So you need an incentive to get someone to do it. That incentive can be getting the loan, or it can be a reduce in price, or we even have some peer-to-peer platforms who've offered money. We've just said, you're going to pay us $1 less on your principal payment if you do this, because we want to get to know you better. So we spend a lot of time thinking about this, and it's actually one of our differentiators, is we're quite good at getting those conversion rates up for our customers. We also believe we're trying to build a credit scoring system where consumers feel empowered around what data is being used, right? So for 100 years, credit data has been this mysterious black box that no one understands. We believe that with a friendlier score, we'll be able to encourage people to actually want lenders to get to know them better. And especially for the good borrowers, for people with nothing to hide, we actually want people to be saying, wow, they actually care about getting to know me and my behaviors and my habits. And because of that, I feel comfortable sharing my data.
Thank you very much, Gideon.